how does our investment strategy and our portfolio actually perform? Compared to the Burgiss Buyout Benchmark, our portfolio has outperformed on a 1-year, 3-year, 5-year, and 10-year basis. And whilst the single-digit IRRs you can see in the first year and the 3-year time frame is not what we nor the industry actually aimed for, but our ability to outperform the market over a short-term and long-term speaks to our selection process and our diligence process. The operating performance of our portfolio companies is also strong. This chart plots EBITDA growth of the ICG Enterprise Trust portfolio and a basket of European private companies and the FTSE All-Share on a yearly basis. The conclusion? Private companies outperform public companies, and our portfolio outperforms even that. Our portfolio EBITDA growth per year has averaged 15% compared to 6% for the FTSE All-Share. The more consistent and higher growth is important for our long-term compounding returns. Not only does our portfolio typically exhibit higher earnings growth, it is often with lower dispersion than public indices. Looking to the 12 months to July 2025, you can see from the blue dashes that Enterprise Trust's median EBITDA growth was higher. But not only that, as shown by the whole bar, Enterprise Trust interquartile range was also tighter. In other words, our companies are typically more stable, less volatile, and with higher underlying growth, as well as being much smaller companies weighted towards attractive subsectors. And this can be seen in the valuation metrics compared to the public markets. So the Enterprise Trust portfolio is experiencing higher growth and is more attractively priced than public markets. And on this slide, we're doing a simple like-for-like exercise. So let's look at it. Public markets and private markets have different sector mixes. So if we take the FTSE All-Share index and apply Enterprise Trust's sector weightings, we approximate a sector-adjusted EV over EBITDA multiple of 18 times and LTM EBITDA growth of 7%. Now, compare that with Enterprise Trust. The portfolio has delivered 15% EBITDA growth, and the valuation multiple is 15.3 times. So the headline is compelling, we believe, higher growth at a lower multiple. There is even more value on offer if we adjust for today's discount, which would imply you can get this higher growing portfolio for an even cheaper 12.1 times. Therefore, we believe you're getting exposure to a portfolio which has better underlying growth characteristics, and you're not paying public market prices for it.